In this presentation, we will continue on with our comprehensive partnership problem with the adjusting entries. Here on the adjusting entries tab, we're going to be doing an adjusting entry related to unearned income, unearned revenue. For more accounting information and accounting courses, visit our website at accountinginstruction.info. So this is going to be on 131 here on B17. And we're first going to look and go through our accounts and see if we can figure out which two accounts are affected, just knowing that we're dealing with adjusting entry related to unearned revenue and knowing our adjusting entry rules, which are that cash will not be affected. There's going to be some balance sheet account other than cash and other than expenses or equity. In other words, an asset or liability account other than cash. So which one would it be if we're talking about something related to unearned revenue? And if we go through here, we'd say, how about unearned revenue? So usually a book problem will actually have to say unearned revenue. So that'll really give away that factor. Now, if you have a trial balance, you'll know what unearned revenue is. Even if you don't have a good idea about it, you'll know it's a liability because it's next to the other liabilities. So that's a reason. If you can have a cheat sheet of a trial balance, have a trial balance, even if it's not related to the problem you're working on. And then we're going to have the income statement account, something related to unearned revenue. A little bit more difficult because unearned, we don't see anything unearned, but we do see revenue or income or revenue or income. And that's going to be the other side that we will have, the revenue or income. So this is a bit confusing, a little bit different than the other adjusting entries because obviously most income statement accounts deal with expenses. We have a lot more expense accounts than income accounts. We hope the dollar amount of income is greater than expenses, resulting in net income rather than net loss. But the number of expense accounts we have will be greater by far, typically, than the number of revenue accounts, and therefore the number of adjustments that are adjusted will mostly be for expenses. So revenue is adjusted here. The rules are the same though. All income accounts only go up. It just so happens that expenses go up with debits and the revenue goes up with a credit. So in other words, we pay us. We only do work and increase revenue. We don't do like negative work and have revenue go down. So that means that we know that this is going to increase, but it's going to increase, of course, by doing the same thing to it, a credit here. So we're going to copy the income, right click and copy. We're going to put that on the bottom at the credit in C18, right click and paste 1, 2, 3. I'm going to go ahead and indent that, probably done for you already by going to the Home tab, Alignment Group, Increase Indenting. Then we'll go up and pick up the other account, which will be unearned revenue, unearned fees, unearned revenue. So here we go. We're going to say copy. And we're going to put that up top in C17, right click and paste 1, 2, 3. So once again, we can know all that without even knowing exactly what we're doing, just knowing we're dealing with unearned revenue and it is an adjusting entry. Now we'll go through and see what we are doing. So in order to tell the story, really we have to know what is unearned revenue, how did it get there? And an exciting story it is. So how does unearned revenue get on the books? So note that unearned revenue has to do with timing. It deals with revenue. So when we think about revenue, the question is, did we get paid before we do the work? Did we get paid at the same time we do the work? Or are we getting paid after we do the work? Unearned revenue, and if you think about that, obviously if we got paid at the same time, the journal entry would be cash and revenue. Typically we do the work at the same time or before. If we did the work before, we would have to debit accounts receivable and revenue when we do the work. And then if we do the unusual one is happening here, which is basically we got paid before we do the work. Remember, that doesn't happen too much unless you're in a specific type of industry. Most industries, we have to do the work at the same time or before we receive payment for it. But if you do something like subscriptions, which is becoming more and more relevant these days for like application subscriptions or newspapers, or magazines, something like that, you typically get paid before you deliver the goods or service that you're going to have. And in that case, we would have the unearned revenue increasing at the point of payment. We're just going to tell our accounting department, every time a customer pays you, debit cash and credit unearned revenue, we can't credit revenue because we have not yet earned it. And then at the end of the month, we're going to decide how much of this revenue has been earned through the process of us doing the work, delivering the newspaper, providing application service for the year's subscription that someone, subscribed to or whatnot. So we're going to do that, a book problem is going to have to tell us basically unearned revenue is this as of the end of the time period. Now be careful with the terminology because the book problem could say, it's most likely that they say this is what unearned revenue should be at the end of the time period. But they could say, of this unearned revenue, this is how much was earned. And if they say that, then what they're talking about is how much of it has been earned. So we can just use that number in the journal entry, meaning this is going to go down by the amount of it that had been earned during the time period. But if they say that this is how much unearned revenue is as of the end of the time period, they're talking about how much is still unearned. So, and that's what we typically will have. So in this case, we're saying 1,000 is still unearned. So we have to do a subtraction problem, in other words, to get this number to what we think it should be, 1,000. So we'll do that here. I'm just going to say it's going to be equal to 3,000 minus 1,000. And that'll be the debit. I'm going to put a little formula negative of this number for the credit. So that means that 3,000 has to go down to get to the number we think it should be, 1,000. So let's post this out and see if it does what we expect it to do, which is to bring this down to 1,000, the amount we calculated unearned revenue to be, and then revenue should go up by the 2,000, the amount that we have earned through this time period through doing the actual work. Okay, so here's unearned revenue. Here's unearned revenue on the trial balance. We're in the middle column in I-14, where we will say equals and point to that 2,000, bringing the 3,000 credit down by 2,000 debit to 1,000. And then here's the income or revenue. Here's income or revenue on the income statement. We're in the middle column, I-21, where we say equals, point to that 2,000. That's going to bring the balance here in revenue up by 2,000, put us back in balance, and bring net income up by 2,000. So here we got 29,000. Back in balance, net income is 7,100. Note this again is one account that is bringing up net income, unlike the more depressing adjusting entries here that have all brought down net income. So the expense adjusting entries typically bring down net income. This one, nice one that we don't see often because a lot of companies don't have unearned revenue. But if they do, will actually bring net income up. For more accounting information and accounting courses, visit our website at accountinginstruction.info.